in your reading is your first exposure to the book. Printing out my concept maps and course Blackboard course management system. Print them out. It's in a PDF file. You have two pages, and then as you're reading the book, put in the notes. I identified the main topics, for lack of better words, in my concept maps, and then you add on to it. We discuss it in a lecture in the class or in a discussion board in Blackboard. And now this is at the end we finish everything else. This is a summarization, so you could look at it and say, hey, I remember this, now it makes sense. Or look at my concept maps and see what I added in or what you forgot about, because I'm following along utilizing the author's reading material, utilizing his supplemental information and the PowerPoints that you have access to, and I just kind of condensed it all into a mind map for you. So if you haven't read the book, I haven't did it, this will make very little sense to you. You may get something out of it, but not to the effect and the impact that you would if you read the book, and now it's just like a summarization. Okay, so let's get going. I've been doing pretty good. I've been keeping these underneath an hour. This is my goal. Remember, you could always stop the videos and go forward. You're doing real well. Remember, we're in chapter 17, so you're almost completed. Make sure you can always see the same video, the full recording on Harper University iTunes U. Look at this video or other instructors that are teaching a similar class or other classes I'm teaching to get a general idea. Okay? So remember, your best bet is at the community college. It's a good solid foundation. This is a transferable course, and you'll have a good understanding. The exams, again, I keep on refreshing the exams at the beginning. I'm really impressed with the discussions and everything else that you are beginning to understand. The terminology is beginning to click just by the conversation we're having within the classroom. Okay, so let's get going. So there's only one web site. Most of the websites you already have them. Remember, even if you're coming in here, you could always go back to the website. The websites, when I identified them in certain chapters, it was for specific items within that chapter, so you utilize that as a resource. But there's other information in those websites. It's excellent for, there's, you also did a great job identifying the good, solid website. There's more out there that you could find, and if you're on an online class or even a face-to-face class, you find some websites or some YouTube or some kind of information that will make the subject matter more palatable, easier for the student. Pass it on to me. I'll review it, and if it makes sense, because it's more of a simplistic supplement to what you're learning from the author, from the book, then I will put it in a link in Blackboard, or as an online class, and give you a couple of points for that. That's how you get. That's how we grow as a collective going forward. And remember, you're going to utilize some of this information for your MMC final project you'll be doing as a team. Okay. And always remember, make sure you respond to the CATME evaluation, peer evaluation, because that's how you'll be judged as a team. It's, I think, like 40% of your team grade is through how your peers evaluate you. Okay, so let's look at components. What are we going to talk about? Multinational costs of capital and capital structure. Oh, by the way, look me up at a college. Call up and say, Dr. George Bachaki teaching this class, or what courses is he teaching, because you've somehow found me on YouTube. Remember, YouTube is out there to as a supplement to help the students. Because some are having a problem accessing Harper University iTunes, or do you want to do anything else with Apple iTunes? I understand that, so I'm just being flexible and offer this recording or flip a classroom as you're in a lecture on the YouTube for a supplemental. But you need to read the book. You need to understand the examples. You need to stop the video. Look at the graphs I have. Look at the formulas I have. A lot of these formulas are just an extension from corporate finance. Hopefully you had corporate finance before you take international finance, because that's what sets the foundation, and accounting sets the foundation. And I'm just assuming you already know the formulas and that foundational, and I'm looking more at the strategy in this class. Okay, so what do we have components of a capital from a multinational capital structure? Remember, I'm a multinational MTN, and now I have to make decisions about my subsidiary. Okay, let me see if I just make this a little bit bigger, because I've noticed when I was doing the recordings, I have a lot of white space. Okay, how about that? Maybe that's a little bit bigger. real quickly. I just want to get the right thing. Let's just go with 250. 250. Okay, that's perfect. I wanted enough to remember. The reason I use the concept maps, you have like here, I think like 40 slides all on one page. So what I wanted to do so you could see how it's the relationship building. Again, remember my concept maps highlight what's important to you. You know it. You don't need all the ands and as. I'm just doing this because it's a transition from utilizing this type of a presentation or a review. Okay, so let's look at overview. What's an overview? Okay, MMC, and I'll go over them, I'll read it, because the more senses you could get involved, the better you're going to remember. MMC's parents, the corporation, the boss, the shareholders, you know, they got subsidiaries. Remember, in MMC, as we talked before, it's like a department, a corporation, got a lot of different departments and functionality. Look at MMC, here's the corporate, and then they have, you know, it's a flat organization, they have subsidiaries, either in logistics, distribution, market, stores, whatever makes sense within their strategic strategy when they're doing within the international arena. Because they're looking at like a treatment, a flat economy, which I'm saying flat, the whole world is one big economic system. And so they don't just which parts or which geographic area I'll be utilizing and maximizing in that. So I've got currencies and everything else we're already talking about that we've talked about already up to this point. Okay, so MMC parents may invest in its own cash in the subsidiary. Cash infusion in the subsidiary represents an equity investment. So I just go cash infusion equity. I voted that. I'm not going to do it all that because I want you to start doing it yourself. If I do it, it's what's important to me, but it's what's important to you to remember. It's how you trigger. How do I say something? How do I pull it back from here when I need an exam? I need keywords, and then all of a sudden your mind starts going like trying to find a file in your cabinet or in your desk. You got all the file. I know it's always in this 1/3 down here. That's where I left it. Okay, so the parent is the sole owner of the subsidiary. That's basically what it's saying. Subsidiaries use the cash infusion to develop its business in the host countries or its operation. The host country's operations. Okay, where the subsidiaries located. Here's an alternative method. Remember, I'm not getting into it. I'm just refreshing it. We already discussed this. Alternative method: subsidiary can build more equity if it offers its own stock to the public. Remember, even if it's a subsidiary, it's part of the MMC conglomerate, and they still could offer some stocks. I look at some restaurants like Burger King, all that, you know, Taco Bell, they're all tied into the Yum brand, and so that's the MMC, for lack of better words. And they have, you know, and they have different fast food restaurants that's underneath the umbrella, but they still stand sustainable by themselves. So they could offer stocks for that subsidiary, but it also could offer stocks for the MMC. You know, as long as it adds value in the overall. I'm looking at the cash flows and inflows from the MMC. It just gives you just an alternative way. Remember, there's a lot of flexibility in finance, how you want to finance that. You got crowd financing now for small businesses. Is this an option to you? There's a lot. That's all. I'll leave it at that. Okay, external sources of debt. Now you've got. If I look at it real quickly, just remember, if you say list a couple, which is not an external source of debt, get a question on an exam, or if I ask you, tell me something about what a domestic bond offering is, a global bond offering, private place bond offering, or loans from financial. These are all external, outside the organization. I am taking debt, so I'm not looking at equity finance. Just taking a loan or whatever I'm doing, offering a bond. So, okay, now a domestic bond offering, remember, take your time, stop me, MMC, commonly agreeing domestic bond offering in their home country. So I'll go MMC, a domestic bond offering. I don't have to say home country. It's easier for you because it's I'm copying what, for lack of a better word, paraphrasing from out of the book, so that we're following the same rationale. I want you to remember, I don't deviate too much. You know, I might have different opinions, but in this course, especially at a community college level, you're getting the foundation, the baseline aligned, so you understand the different terminology. That's all I'm doing. You learn the language, how it functions. As you take more, you go for your bachelor's, and you go for your master's, and you go for your doctorals, and you're taking international finance or international management. So you're going to be covering all this information. Then we start getting into more of you being able to debate, yes, I agree with this or not, but not just a little, getting a little bit. It's more like learning a language, okay? So MC commonly, all right, so remember, I'm just doing this, and that's how I'm going to remember it. Okay, so, because if you ever looked at my mind maps, I would have got rid of all this, it's domestic bond offering and, and local currencies, and that's all I have to do, and I will remember that. Okay, so now let's say global. I'm always trying to helping you learn how to use the mind map to your advantage. There's a lot of information, and in finance and management, as you're going forward, the more and more information. How do I condense information to the simplistic term for recall? This is simplistic. If you don't understand what it means, it's irrelevant. A computer, I look at the formulas, just plug in a number, don't know what it means. It doesn't do you any good. Remember, this is to help you retain information, bring information back so you can see the whole picture. Certain keywords that will help you out there. Okay, global bond offerings. MMCs can engage in global bond offering in which they simultaneously sell bonds denominated in currencies of multiple countries. I can sell different countries. That's my market. The different exchange central banks. Okay. Now, private bond offerings. MMC may offer private placement bonds to financial institutions in their home country or in foreign country where they're expanding. So I could just do it just for here, a bond, and people already got the name recognition or whatever. Remember, I'm thinking about where do I issue, where do I go out for credit, locally, financially, which makes the best. It's looking at you're basically looking at the currency and all the factors that we've talked about. Okay, loans from financial institutions. I just leave it at that so you could, right now, so you memorize and you remember this chapter, what it's talking about. Even though after a while it's all going to click in, you're going to see how everything you've learned, and even the other class, when you look at SWOT analysis, is most likely what we're doing here. When do you hedge, when do you buy certain contracts, is the discounts. So those are all strengths and weaknesses that you're looking at utilizing that technique when you're doing investments. Okay, so loans for financial institutions. MSC Parents borrows funds from other financial institutions or other corporations, wherever, or banks, wherever I'm going to get the best deal for my money. That's my job, the best deal of my money, and looks at the terms and conditions, not only the interest. The interest is what I would call my hook to bring somebody in. Right? The rest of it is the term and conditions. What is the contract? What happens if I'm at fault? What is my late payment? How do I get out of the contract? What happens? Could I, what do you call it? Refinance my contract? Do I have any callable options in the bond? All those could be in there, that's standard, but you could say you're high risk. I don't want this. I don't want that. You want the money or not? And here's the terms. Or you always try to remember your job is always to protect not only the subsidiary but add value to the MNC parent. I keep on stressing that to the whole class. Okay, external sources of equity. Now, equity is basically, I'm selling something. Domestic equity offering, global equity offering, and private equity offerings. Okay? So, one, domestic offering kind of makes sense. MNC can engage domestic equity offering, which funds are dominating local currencies. I could do sell stocks. I do something that I had that's domestically, and it's not a loan. It's something I'm doing that I could a service or something, or bartering something I could offer within the domestic, okay, in their home country. I'm not doing where my subsidiaries at. That's where the MNC is at, my shareholders. Okay, global equity offering. Some MNCs pursue global equity offering in which you can simultaneously access equity from multiple currency. Similar to what you're doing in debt. Do I want that? What's your strategy? Do I want to do debt? Do I owe money? Or do I want to have equity? And there, later on we're going to discuss, there's a balance, a comparison, which was better. The bottom line is, how much money do I get to keep? Do I pay? All right? I'll explain that. I don't want to jump ahead. Okay, private. Well, I could kind of jump ahead. You already the material already we discussed it, so it's a refresher. Private placement of equity. Offer private placement of equity, financial institution or home or foreign country where they're expanding. So nothing changes. So we have this one was pretty good. So gave them some information, right? So I'm put this back in. So components of capital. No problem. Okay, now MMC's capital structure decisions. How do I make the decision? There's three, the author talked about three, and here are three main ones. And remember, I cover everything in the book, even though in the exams have to be covered, or in the lectures, I'll focus in what I think you should need. But the information is, for some of you, this will be the only international finance class you had, so at least I touched that in here. Like anything else, I'm just planting the seeds, and then over time, they'll water and they'll grow and they'll flourish, and they'll be second nature to you. So don't worry about that. Influence of corporate characteristics. Okay, and we've had a lot of this. MNC cash flow stability. One, MNCs with more stable cash flows can handle more debt. And remember, the whole thing I was saying, I don't want those big spikes that make a lot of money. I want a constant cash flow, so I always have just the right amount of money to pay my bills, maybe a little bit extra to make some money. If I got some extra, I don't keep it to the year end. That's not good financial practice. I take it and convert it and see how I could make money off the money or pay off some debt or reduce something, even if it's short term, just because the factors and environmental situation is beneficial for that strategy that I'll be implementing. And remember, there's a lot of strategies we talked about in chapter 17, so those are the strategies that you'll be working on for your own. And the way you learn is when you're doing your own MMC as a team, you'll be able to pick up something that you feel comfortable with and gives you a good baseline, and then you just add on more as you take more classes and you get to understand the different conceptual ideas. Okay, so you've got cash flows can handle more debt. To cover periodic interest payments on the debt, because there's a constant flow of cash inflows, in and out. Okay, MMC's credit risk, again, MMCs that have lower credit risk, a better credit score, have more access to credit. Okay. Okay. MMC's access to retained earnings, highly profitable MMCs, right? Remember, retained earnings. I don't give it out to the profit. Is because I want to expand my business. Same thing with you. I get a raise. I save money, buy a car, or I buy a house. I do something else with it. Most of their investments would retain earnings, and therefore use equity-sensitive capital structure. I have to look at what's going on, and it's all sensitive. Looking at the inflation rate, looking at interest rate, looking at everything we've talked about. Okay, the exchange rate. Those are the three big ones we've talked about. Okay, MMC's guarantees on debt. Dollars. If parent backs the debt, the larger corporation for the subsidiaries when it's taking out a loan, it's like a parent. I co-sign for my son or my daughter. It's a problem. If they co-sign, I pick up that debt. I'm part of the responsibility for the parent MMC. The subsidiaries, borrowing capacities might increase. MNC agency problem. Remember we talked about that before a couple of chapters back, where agency problem in a foreign country are not easily be monitored by investors from the parent companies, so agency costs are higher. When I look at agency, just a refresher, the agency problems is a management from that thing is looking more at a self-sustained business unit, and they don't have consideration of what effect they're doing here. They're doing profitable, but in long term, it is affecting the MMC parent because of their strategy is to minimize the cost, and here you're spending whatever the strategy is. Remember, that's where you have your agency costs, and then plus they're not watching them. I have to rely on the management there that they're doing the right thing. They're always looking out for the back. If not, then I replace the management, but it still could be a painful restoration if they go out too far, if I don't catch it. So I still should be monitoring that. It's just something to be aware of. Okay, the next one, so that took care of our, look at everything we have for corporate characteristics. It's just a corporation. Remember, we're down into the micro. Now let's look at influence of the host countries. Right? And the whole thing we're looking at is capital structure, which theory, which strategy would I be utilizing? Okay, so now, in which subsidiary will be the one that will be selected. Influence of the host country. So I have that, the MSC, I have that information. Interest rates in the host countries, we talk, cost of loanable funds may be lower in some countries. And sometimes I may just do something else and bring the money out and just exchange cash because it's got stronger currencies there. Okay, strength of the host countries of the currencies. Let me move this over so you can see it. You can see I know my picture's right in here. If the MMC expects weaknesses of currencies in its subsidiaries, host countries, so that's one of the strengths. The other one is of the currency. If the subsidiary's local currency expected to appreciate, it has value, then the subsidiary may retain and reinvest its earnings in the subsidiary's local instead of using the parent or transferring it. I'll just keep it in there. Remember, we're also looking at the other factors just thrown in. The remittance. What's the rules from the government telling me I can bring the money back? It may all make sense for me. I just have to understand strategically how to utilize the money and maximize the money so I get the most out of it. just like I would a product or a service. It's a capital. Okay. Now, country risk in host countries, we talked about that. MNC subsidiary is exposed to the risk that the host country may be confiscated. We talked about how you minimize that. The subsidiary may use debt financing in that host country. Hey, if there's a risk, I'll borrow it there. Hey, and if you're gonna take it over, hey, take the debt over too. I'm out of here. It's like some people did with the mortgages when they were overvalued and they thought they had a deal and the market fell out. They just walked away from it. Say, hey, I don't care. It can bankruptcy in 7 years or even closer. I got someone to close sign. I'll be back up and running. Okay. Now, tax laws in the host country, foreign subsidiaries may be subject to withholding tax when they remit the money back. Okay, and the last one we're going to talk about is the response to changing country characteristics. Excuse me. Okay, response to country changing characteristics. Okay, country characteristics. What are country characteristics? They vary among the countries. We already discussed that. So you should have, again, when you're doing the analysis of the selection or the capital, where you're going to make the utilize the best location. So you look at different analysis, different scenarios, and remember, you have software to do that. Don't try to do it in your mind. Your mind just gives you that gut feeling. The software kind of just solidifies and justifies that yes, you are on the right track. It has the probability, statistical information for me to convince my shareholders are the ones that this is the course of action. And at the end, if I do well, they love me. If I do poorly, I'm looking for another job. Okay, not that bad. It depends on what you lost. Okay, if I look at the country characteristics vary, therefore the ideal capital structure varies around countries. That makes sense because everything's unique. But you have to look at it. It's unique now. What's going to happen in the near future? Okay, now subsidiary versus parent capital decisions structures. Now what I'm looking at, and real quickly, what the name is telling me, here's a subsidiary. I'm doing by different colors, and I got the colors. These are the main objectives of the chapter. Okay, subsidiary versus parent capital structure decisions. Okay, what's the overview? Some subsidiaries are subject to condition to favor debt financing, while others are subject to favor equity financing. I was going to say equality. Equity financing. One says it makes sense because a strategy to take a loan out, like we mentioned before, because you may have some fear that the company, the host country is going to take over or something else. The other may be just because the environment is out there, or you're just testing out. Yeah, or you got a good deal on the debt, but it depends. Remember, the strategic for that organization. Are you debt financing or equity? The bottom line is, look, if I'm paying a mortgage, I'm paying somebody else, I'm paying the interest, but that interest I could write off on my taxes, or reduces my taxable income. So I'm paying the bank, or a firm, or whoever is carrying my note. Or I pay off the mortgage and I'm just pay it off cash. Now cash has the other thing, I'm paying taxes. Which one leaves more money at the bottom end after I pay everything else off to have more money? Is it tax deductible, gives me a higher return on my investment or more, or do I, yeah, and it depends on the industry. I think the oil industry is real heavy more into debt because they have to have the infrastructure, so it takes a longer time. Utilities are very heavy into debt. All right, but they're solid. They need that. There's no way I could pay for all that infrastructure, equipment, and everything else, the capital investment, and turn that over right away to a building. So I stretch that over 25 years, 35-year period. So it's acceptable in that. So I'm not looking at the high profitable margin, but I do make a profit through the dividends. So that industry, it works well. Other industries, it may not. Okay, so the impact of debt subsidiary finance. I'm just refreshing some of the conversation we had in the classroom. Impact of increased subsidiary debt financing. When a subsidiary relies heavily on debt financing, its need for internal equity financing, retained earning is reduced. I don't have to keep the money because it's cheaper for me to. It's more effective, more favorable for me to take a loan because I got a good credit rating at a lower rate, and I use the money to make money off of that if I need to. Remember, the whole thing is when you have zero financing is that they expect you to default and they go up to the higher rate. So if you do default, you still have that money used in someplace else, take the penalty and the premium, bring it in, pay it off, and you're all right. Problem is, a lot of people get the loan, and that money that they had that is there, they invest it again in something where they can't touch it, or they spend it, for lack of better words. or they have it locked up, or they can't pull it out for a longer period of time. Okay, they underestimated what the interest rate's going to happen. Okay, impact of reduced subsidiary debt financing. Subsidiary will need to use more internal financing, will remit fewer dollars to the parent, money back, and reduce the amount of internal funds available to the parent. That's something that strategically, but how long do I need this capital investment? Is it a couple of years, 3 years? I could hold it off. I could have got other subsidiaries that are at that time they're at their peak, but I may be turning them down or selling them off. So I'm looking at this. I'm looking at my bank account just like I do. I get different streams of income coming in. I'm working several different colleges, different work I'm doing, and all that in gives me my major. If one drops down for whatever reason, there's other ones that hopefully will pick up, or one I'm ready to get rid of, and I try to find a substitute. No different than what you're doing in here with different subsidiaries, but you're looking at different decisions when I open up, utilize my capital investment cash. Okay, limitations in offering a subsidiary leverage. Foreign creditors may charge higher loan rates to subsidiary that uses highly leveraged local capital structure. They believe the subsidiary may be unable to pay its high debt repayment. Remember, I use too much of a collateral, too high on that. If I default, there's no way I could pay it back. The higher risk, I want more higher payments now. Hopefully, it'll offset it. When I look at the salvage, I'm looking at the as the creditor this time. Okay, let's go. Multinational costs of capital. I always like to throw it in. I keep on forgetting on here, just like in the classroom. I just don't go. Remember, my lectures are uh, I give you a general idea what we discussed, try to tie it in, and give you a quick overview. So if you're listening at this as your MP3, you're driving, you still have some information. Or if you're a student that has a visual restrictions, you can't see as well, and you need to have more of a verbal, auditory type of discussion, I'm at least reading everything else out for you. Or you could read it, stop it, and take your notes. Okay, MNC cost of debt, and this is a multinational cost of capital. MNC's cost of debt is dependent on the interest rate. No kidding, you've learned that. That it pays for borrowing the fund. Okay, very basic, simple. So if I'm looking at what's the cost of debt to the MNC, and some of the questions I ask you, use your common sense, try to use the vocabulary, you'll do well. I'll try to have some short answers, because people do better in the short answers than a multiple choice in some of the finance classes, because they can understand that they may not use all the terminology, but I have a better idea of what you're trying to say. Okay, multinational MMC's cost of equity. Okay, MNC creates equity by retaining earnings or by issuing a new stock. You learn that in corporate finance and in accounting. MNC cost of equity contains a risk premium above the risk-free interest rate that compensates an equity investors for their willingness to invest in the equity. Estimating MMC's cost of capital, here's the equation, and I had this, remember, in the book, they have the chapters. The only thing, like I said, I complain about the book is very small print, but they're trying to keep the cost down of the book so they can put as much information on the pages. If I'm looking at that, remember, they have the examples to walk you through it. Here's just an overview. Here's the formula. You have a weighted average of a capital, amount of the firm's debt. You have before tax cost of debt, corporate tax rate, right? You're plugging in the numbers, the firm's equity, and cost of financing with the equities right here, all right? So you have all that, so now you got comparing, that's the regular formula, and we've talked the formula earlier. We're just expanding and it keeps on bringing it back. Eventually you'll see it. Comparing costs of debt and equity. Okay, here's the exhibit, and what I'm trying to do, here's the cost to debt ratio. I'm trying to be here where it's at break-even point. It's level. I got to balance just right, okay? That's what I'm trying to do, cost of capital and debt ratio, how much for appropriate core capital structure. Okay, advantage to using debt rather than equity capital. That's what we're doing that. You have to look at this, it's a plus or negative. Okay, because interest payments on debt are taxable. Oh, I see what I got this. Debt or capital, this is just a subject matter. I'm trying to figure out how I set this up. Okay, the greater use of debt, the greater the interest rates, and higher probability the firm will be unable to meet expenses. So if I go into too much debt, after a while, it's no different than those of you who've taken me for personal finance, or if you've taken me for a business organization, and I make you do your own equity thing. There's a software out there online. I forgot, it's like a banking a link. I forgot. And you go in there and it says how much investment you have, how much money you make, how much you pay for rent, and it's kind of give you an idea how much your own capital structure should be, how much you to be successful for the next 3 months, 6 months. I mean, so you could survive in case of some. If you lost your job, how many months of savings should you already have to hold you through till you get the next job? It should be like 3 months, 6 months. I think now it's almost like 6 months or plus. You need more because it's a little harder because of the job market, even though it's opening up. Okay, so as an MMC increases the proportion of debt, the rate of return required by potential new shareholders or creditors will increase to reflect the higher probability of bankruptcy. We talked about that. Cost of the capital for MMC versus domestic firms. Okay, now here are the 5 items. So do I pay for it from MNC to parent, or do I let the domestic firms, my subsidiaries, trying to find its own way to pay for its capital expenditures? Okay, so I'm looking at the size of the firm. I'm looking at access to international capital market. I'm looking to international diversification, exposure to exchange rate risk, and exposure to country risk. Size of the firm. MNCs that offer borrow substantial amounts may receive preferential treatment. Yeah, it's late. I'm doing fine. From creditors because larger amounts because they want you to come back, so to give you a deal, economies of scale, for lack of a better word, by therefore reducing its cost of capitals, access to international capital markets. MMC's access to international capital markets because I have subsidiaries all over. I have contacts, relationships with different central banks, different countries, different political, different governmental entities legally. May allow it to obtain funds at a lower cost and then paid by domestic firms. So I don't have, I need the money here, but I'll take the loan here because even though I don't need it for this subsidiary in this country or geographic area, but the money is available for me because of the economy, whatever. So I'll take it there. It's cheap money. I'll take it, and then I'll see how much it costs me to transfer it back to the other host country, back to the parent country, or directly from one subsidiary to the other, which makes sense for the in the book it tells you I'm always going back against the dollar, but in reality you may be going against one currency or another currency because I'm not bringing it back to the parent. I'm just bringing it over into the other subsidiary because I got a better loan. Okay, international diversification. If a firm's cash inflows come from all sources from all over the world, those inflows are more stable overall. It's like a GPA. I do well here, some are better. It's how the Federal Reserve looks as a country, but I got different streams of income. So one's hurt, the other one may offset it. Basically, what I'm looking at is more have a level. Takes care of my peaks and my cash inflow and outflows. Okay, well, not be highly influenced by a single economy. Okay, exposure to exchange rate risk. Again, MSC's cash flows will be more volatile than those of a domestic firm in the same industries if it is highly exposed to exchange risk. This is one factor. You have to look at exchange risk, and exchange risk only makes a difference when I'm moving the cash in and out. So it depends on the timing. Sometimes I may have to leave it a little bit longer than I want, but then I have to justify in my annual report to my shareholders at the parent MMC. Always got to let your shareholders know that you're still looking out for them. Also, that the management, I don't have any kind of agency costs. If the agency's costs going up, it's already red flags. I should be always looking at everything else. And remember, software does it. You have the dashboard that at least gives me an indication, the health of what's going on. But you have to decide which factors are important for your strategic objectives for the parent MMCs to add value to those shareholders, but also add value to the subsidiary because that's what grows. And remember, subsidiary, if it grows, I may sell it, or if something happens here, I may have a restructure. This may be my new focus or cash cow because that other thing is obsolete. I did change. And I want to look at. I won't do anything, but if I was doing some research with Kodak, Polaroid film, the people don't use Kodak. It's all digital. They do some very little, and you basically have to phase it out. But they're automatically phasing into the digital stage, but still printing out. It has some kind of a different options. Okay. Exposure to country risks, establishing foreign is subject to possibility holders seize the subsidiary's asset. And again, here's the cost of capital, large, the greater access. So it has all preferential. I just said, remember, English is a second language, and I am dyslexic, so some words I turn around like Lance, I got to refocus back in there. Why did I tell that? So you know, you just have to do it. I was successful, but you just have to work a little bit harder. Right? Someone else picks up that on. Other ones, it's hard. Don't worry, you'll do fine. You gotta just don't give up. You keep on pushing it forward. I'm always trying to get you to it. Look, you're already in chapter 17 out of 21 chapters. You've gotten this far. Keep it up, okay? And a reduced probability of bankruptcies and increase. It's just kind of a nice flow chart. Gives you some information. Okay, now cost of equity comparison using the cost of equity using the capital assess price model. Put that in. I forgot what the CPA was afterwards. I think of the Kansas police patrolling. Chicago has that. Remember, a lot of acronyms. Okay, so here's the equation. Equation real easy. Required return investment, risk-free rate of return, market return, and a beta stock. And again, when we talk about beta stock, is the sensitivity of stock when returning back to its market, and I've got it someplace in here. Okay, so I got the Morningstar, and I look at the Morningstar. Is select the Vanguard 500 index, clicks on risk management. I'm just going to click it to make sure it's working. Oh, perfect. Again, when I'm looking at this, so you go Vanguard 500. I have to close this. Join Morningstar. Register for Morningstar. Yeah, I'll do that later on. I always like register to kind of get information in there. That's what keeps you current. They want you to sign up for more. But remember, when you get all these emails, and then have one just for your finance or your book, you have different emails that you have this, what do I call my research email. So I have all this information, and that's how you can keep on current. And then if you need more explicit, then you can find out, but it gives you a good general information on there. So it's got the Vanguard on here, Morningstar Market. Click on the risk management, and I have to find it in here. And then when I'm looking at your portfolio theoretic, and then view the beta, the sensitivity on that. I won't go into it now. I want you to play with it, but also when you're in there, look at the different markets, look what they have available in here. All right. So the links are working. I created the links for you. The links are in your Blackboard Course Management. It says Other Links by Dr. George. Click on them and use it. Now remember, when the Blackboard Course Management is closed, it closes after a couple of weeks after the course is done. You still may have some access into the publisher stuff for 6 months. You get the electronic book, but you should start saving those websites here. Okay, now implementation for the cap, and again, when I'm looking at the cap, I go to the capital asset pricing model. Let me get that in here. For the MMC, is the U.S.-based MMC may be able to reduce its beta, the sensitivity, by increasing international business. Implications of the CPA for an MMC products. That's what I'm doing. And here's the beta. Beta is basically a sensitivity of stocks to market returns. The U.S. stock index is normally used as a proxy, right? This is instead of when accessing stocks for U.S. companies. Okay, implementation. Geez, I want to have a few more. I hope I make this. I don't have to stop recording. I don't edit that I could, but I don't do it in the classroom. So you have me live. That's what I like about this. This is the closest thing you do for a live session. For those of you who have me for online, that you at least have who is Dr. George, the book. Everything else is nice to have the auditory and the face. You can always turn me off and just look at the maps and go through that. It's up to you. But the more senses you involve in the learning process, the higher probability you take it from short term and you implant it and anchor it into your long-term memory. So when you need it, you can pull it out. So the keywords, remember, you learn the keywords is like you're searching on Google or something else. So once those keywords, you pick them up, your mind's already trying to find out where's that keyword associated with, and then hopefully you'll come back to this chapter and this concept map and go, oh, now I see it clearly. Okay, implications of the cap. Yeah, all right. So if I'm looking at the capital assessment pricing model, okay. Let's see where the heck was I. For the MSC products, okay, many products of U.S.-based MNCs are in foreign countries. Their cash flows are less sensitive to U.S. dollar market conditions, leading lower project betas, which is fine. Okay, applying the cap with the world market index. Any world market may be appropriate than a U.S. market for determining the betas of U.S.-based MMC. And that took care of that. Okay, so we turn that off. Okay, now cost of capital, cost of countries. Not too long. We're almost done here. I will probably make it in an hour. Look, I'm not trying to finish it because remember, most of these my classes are 3 to 4 hours lectures. Even though 15 minute if you're taking me in a face-to-face class or an online class, we have the discussion board, so you have a lot of more time. I'm just trying to push this in because after 20-25 minutes, your mind turns off. So if your mind turns off, don't just listen and fall asleep. Stop me, pause me, take a break, have a Coke. Coca-Cola or Pepsi or whatever you like to drink, soft drink, health food, whatever, and come back and now your mind's fresh and pick up, or the next day. So stop it. Otherwise, it's like, it's not like in the Matrix, it's being absorbed, it's in one ear out. It's probably in there someplace in your mind, but will you remember it when you need it? Okay, it's like I misplaced it someplace. I couldn't remember where I put it. Country differences in costs of debt, differences in risk-free rate is, okay, debt is perceived to have no risks of defaulting on the loans. The interest rate charged on the loans to the country's government. Differences in credit risk. The credit risk premium paid by the MNC must be large enough to compensate creditors for taking the risk that MNC may not meet its payments obligation. And you still could have some insurance, some hedging strategy in there. Remember, we're just talking this chapter, capital, as an overview. So when I'm looking at an exam, and I'm not going to scramble the questions, go by chapter. What's the concept? What's he talking about? What's he asking for? And then you'll be able to figure out the question. Don't try to remember. You know the main parts of it. No matter how the question is presented to you, you'll be able to critically analyze it and critically discern and come up with the right answer. And you got that good intuitive, yes, this is correct. Comparable costs of debt across countries. Again, some positive correlation between country cost of debt levels over time. Remember, just some kind of a pattern when you look at correlation, for lack of a better word. That I could utilize that pattern, historical data. Nothing's guaranteed, but it gives me a feeling if I do it this way, if everything is the same parameters, I should do all right. Fingers crossed. And here's the exhibit 3, and I forgot what I did for exhibit 3. So you got different countries and look at the patterns. So U.S., if I look at the patterns, it looks, I'm looking at globally, even though the currencies depends on what's happening at the individual countries, versus Canada, U.S. But overall, when I'm looking at this, what's happened to the economy as a global? Do you see what I mean? All the countries. These are just a few of the list. If you had every country, was there an economic meltdown? Was just something happened? Was a slowdown in China? We're a global economic. We work in a global economy, like it or not. Whether you think you're local, you're still involved with what's happening in the global. Okay, so the last thing in here is country differences in cost of equity. Oops, sorry, what did I do in here? So I have the difference in risk-free rate. When a country's risk-free rate interest is high, local investors would only invest in equity if the potential return is sufficiently higher than they can earn in a risk-free rate. Hey, come on. I got to make money on money. I don't want to break. If I break even, I'll put it where I know, say, put it in a bank. But if there's some risk in there, and I'm looking at the risk, it's not that bad. But I gotta take it out from a safe environment. So anything could happen. So well, not everything. I still have some control, but there's that possibility, and that's why I do the hedging and other factors, which we will call risk management and finance. Okay, differences in equity risk premium. This one is here in risk-free premium. An equity risk-free premium based on investment opportunities in a country of concern. Remember the subsidiary. A second factor that can influence the equity risk premium is the country risk. You're looking at all these and you analyze all the charts. Okay, let's look at our summary. We done? Hey, pretty good. I think we're doing fine here, class. I did a little color. Color is nice. It's offset, so it's not all black and white. right? I hate a book that's all black and white. I like the color. Some people do. I think that's why a lot of times you look at manuals and procedures so boring because it's just one color. It's like someone say, "My name is." So I want to stimulate that. Remember, the math's in there. You need the math. But what the whole thing when you look at finance and everything else, other than accounting, here's the math, you know, the problem. You have to understand what's going on. So when you're explaining it to your management, when you explain it to your customers, when you explain it to your shareholders, you could explain it in the terminology that they understand it, not in the terminology of a finance guru, because they'll go, "What the heck is he talking about? Here's the formula. Here's you're going to make a profit. What is going to happen? Here's the risk. Here's this. Interest rate is the same. The exchange rate is changing. The inflation rate, which is a CPA, Consumer Price Index, is whatever. I'm saying it in words, not in equations. Equation, if I'm talking financials, I understand it, but most of the individuals, you may be like the shareholder, may not understand it, so you have to explain it to them in their vocabulary, in their mindset that they understand it, so they don't sell you the shares because they lost confidence in your organization. Somebody always buy them. Okay, so here's the summary. I put these little magnifying glasses so you could look at it closer because this is the end. So we talked about, real overview. Capital consists of debt and equity, access debt through different measures we talk about, how to access equity, leverage derivatives, MCA capital structure decisions is infused by what. And the next one is here. Let me just bring this up here. Cost of capital will be lower for MNC than costs for domestic firms, and costs of capital vary across countries. Saying all that, let's slow down and get your concept maps. And now this is your quick refresher. So always look at this. Do I understand the summary? And then go back to the body, which part. You need both. This would be like your index if you have a question, if you're looking at that. Okay, MNCs can access debt through private placements of debt, no problem, domestic debt offerings, global debt offerings, and loans from financial institutions. So if I give you a short question, MNCs can answer debt through, you will just remember a private, over the counter. You could do what do you call it, domestic, or the venture capital. Somebody else could come in there. Domestic debt offerings. You have global debt offerings. So you just list them all up. So I would highlight all of them. MMC can access equity. Now I don't want to do that. How do I don't want to take a loan out. I want to do it from internally. Retain earnings. Remember, that's another question. By issuing stocks to domestic offerings as equity, I have more partners, so I'm giving up some of my control. Make sure if I have the majority, because if I sell too much stock through equity and they buy more stocks, then all of a sudden they're the controlling interest. And you see a lot of companies, they get too carried away because they're buying all the stock, but they're not maintaining it, so they have more people, other people own it, and now they bring in a new board of directors, they bring new management, and they could change the direction of the organization or decide to sell off the organization. Okay, through global offerings and private placement of equities. These are all main topics. And I have them in yellow to tie in. I'm trying to do a little more coordinated. I've done the concept maps for other classes. I'm doing a management class, and I'm teaching managers how to do concept maps by hand, and then later on I'll transport it utilizing this software. There's other free software. We're in free software. You get what you get. This is one you pay for, and it does pretty good. It works well with Microsoft Office. It's mindjet.com, I think you look at it. You buy individual license or license for your organization. Okay, so if I'm looking at this, I'm using more color, and you see more colors, more symbols, because that's more things for you to remember. And I'll try to do it constant. I'm kind of finding out I got the flavor, which will work in here, because I got different flags and everything else. I'm playing around with it and seeing with the feedback I get from within the class, and then I'll adjust my PowerPoints and my concept maps going forward. It's a learning process. Remember, the whole thing is understanding it, but the biggest thing in a manager or finance is how do I explain it to non-financial individuals, like some of you are in my courses here.
Okay, if an MMC subsidiary financial leverages deviates from the global target corporate structure, MMC still can achieve the target if either another subsidiary or parent takes the offsetting position in the financial leverage. Even with these offsetting effects, the cost of capital may be affected. So they're coming in to trying to shore it up, all right, and help out on that. Okay, now the other nice thing we talked about is MNC corporate structure decision is influenced by what? Corporate characteristics such as, right, cash flows, risks, access to earnings, capital structures also influenced by characteristics of countries where you conduct a business. This is all refresher. Remember, I heard that before. The way you're going to learn new language is repetition. Repeat, bring it in, talk it in, repeat, learn it. You're studying, there's a lot. I'm doing what I'm trying to do. I think I've adjusted in this class. I'm trying to do the quizzes instead of midterm, and the final is right after chapter. You do the 10, 15, 20 question, and you move on, and then you have a final. So this way, it reinforces you studying everything else, the concept in chunks, and hopefully you understand it at the end. May allow you a cheat sheet. I'm not sure yet. Hey, you got me on YouTube. I said I'm not sure yet. Okay, capital structure is all, or in the video, capital structure is also influenced by characteristic countries where the conduct conducts business such as interest rates, strength of local currencies, country risk and task laws. Some characteristics favor equity intense capital structures because they discourage the use of debt, depending on your strategic approach. And mostly it's for the, remember, it's the MMC parent. You want a good strategic approach for the subsidiary, but it also doesn't add value. But sometimes it may not add value, but it's something that you have in there that you want to control that part of the operation because it adds some value or logistic, or you're using it as a trump card for something else that you want to get as a trading card, for lack of a better word. So you're just there for a couple of years, you shore it up, you keep it, and then you're looking to spin it off. That's part of your strategic strategy. For controlling equity. I own it. Now, what do I sell off? It's like a garage sale. I got stuff. Hey, what do I need? I don't need it anymore. I do need it, but I'll get a newer one. I'll get rid of this one. And we also had the salvage value that we talked about. Characteristic of favorite debt intensity structure: the desire to protect against risk by creating foreign debt. Okay, it could be a poison pill. I got so much debt that I got to pick up all the debt. Do I want to buy that? It's almost like a marriage. You're going to marry someone else. I love the person, but see how what the credit score is, because you're adding on to their financial woes that you're going to bring in with them. Okay, because of characteristics peculiar to the MMCs, including its size, access to the international capital market, and its degrees of international diversification. Okay, popped up in here. Some characteristics peculiar to MMCs can increase the MMC's cost of the capital. It could be just peculiar to that MMC or that subsidiary for you, such as exposure to exchange rate and to the country risk. That's for your operations. There's no way you could get around it. You have too much invested because you have direct investments there, and you own the property. It's not a loan, so you're stuck with it. So you try to do the best of it. You minimize the bleeding of the cash outflows or expenses. Okay, cost of capital vary across the countries because countries' difference in components that constitute the cost of capital. Specifically, there are differences in what the risk-free rate, the risk of the premium on the debt. Debt. Sorry, class. Okay, and the cost of equity among the countries. Countries with higher risk-free rate tend to exhibit higher cost of capital. Okay, so we took care of the summary. Hey, we finished. We finished another chapter. I know you're happy. I'm happy too. All right, so we've done a lot here. We've coming up. We're more on the terminology. We're on the things. You're almost at the end. 17. You got 4 more chapters, and then you're finished. Remember, because I think it's 21. 21 is like a blow-off chapter. I'll be very light on that, but so you're doing very well. Okay, so again, my name is Dr. Jordan Machaki. You're taking me an online class or face-to-face class at Harper College, and this is